Hi, my name is Jacqui Gillett and welcome to our group presentation for Accounting Theory and Analysis. The corporate failure our group has chosen to discuss is that of Slater & Gordon Lawyers, a multinational law firm that was the first in the world to become publicly owned and listed on the Australian Stock Exchange. This alone raised ethical and practical issues, including potential conflicts of interest between the firm's obligation to shareholders and their legal obligations. We've chosen this company based on ongoing prominence in the media, as well as a share price which has plummeted from a high of $8.07 on April 7, 2015 to its current value of 9 cents as at May 6, 2017. The fallen share price has roots in the company's acquisition of the professional services division of insurance technology firm Quindell in April 2015. Shortly after this acquisition, an investigation into public statements by Quindell about its 2013 and 2014 accounts was launched by the UK's Financial Conduct Authority. News of the investigation saw the share price slump, dropping to less than half of its highest value by the end of June the same year. A few months later, an audit of the firm conducted by EY revealed a number of accounting discrepancies which substantially affected Slater & Gordon's figures for net profit and net assets for the previous 2 financial years. The result was a further drop in share price, with shares trading at less than $1 by the end of 2015. Shareholders have been outraged at their losses, filing a class action lawsuit against the firm in October 2016. Presence in the media continues, with reports of ongoing legal disputes and finance restructuring efforts. This will be further discussed by Jonathan in the next section.
I'm Jonathan Dewey, and I'll be outlining the reactions of Slater & Gordon's stakeholders, as well as identifying key warning signs for the failure. The further Slater & Gordon's share price has fallen, the greater the scrutiny the firm has faced from its stakeholders. Once praised by the media for its first-of-its-kind IPO and its apparent meteoric growth, numerous media outlets have since labelled the decline of Slater & Gordon as one of Australia's most spectacular corporate failures. Slater & Gordon's stakeholder concerns, however, extend far beyond media critique. In December 2016, ASIC served Slater & Gordon with orders to assist its ongoing investigation into possible falsification of the firm's 2014 and 2015 financial accounts. Britain's Serious Fraud Office is also actively investigating the firm's UK operations, while a group of shareholders have commissioned forensic accountants, CFRA, to privately review the firm's accounts. A shareholder class action has also been initiated against Slater & Gordon, opportunistically facilitated by the firm's largest Australian competitor, Maurice Blackburn. As of late 2016, more than 3,000 shareholders have registered their participation in the action, predicted to be worth up to $250 million. While shareholders claim to have been blindsided by the dramatic decline in the firm's financial standing, there were arguably several red flags which foretold of Slater & Gordon's impending woes. As outlined by Jacqui, perhaps the first of these red flags was the very business structure of Slater & Gordon, a publicly listed company, and this structure's potential incongruence with the fiduciary obligations of legal practitioners. Business structure aside, there was also strong evidence that Slater & Gordon's management did not have sufficient knowledge and expertise within the UK market at the time of the $1.3 billion offshore acquisition of Quindell. Indeed, had management possessed greater understanding of the UK market, they likely would have recognised a third major red flag: the incumbent Conservative Party's stated intentions to overhaul UK tort law to restrict perceived frivolous personal injury claims. The implementation of such a policy would, and eventually did, dramatically reduce the anticipated earnings of the firm's UK operations. The biggest warning sign, though, was undoubtedly the numerous reports into Quindell published immediately prior to Slater & Gordon's 2015 decision to acquire the business. One particularly well-publicised report found that up to 80% of Quindell's recorded profits were based on revenue which had not yet been confirmed with adequate certainty. Indeed, a 2014 report conducted by hedge fund VGI found that Slater & Gordon itself had seemingly overvalued its work-in-progress accounts and regularly inflated the accounts of small firms upon their acquisition. Jennifer will now discuss the issue of who is responsible for the failure as well as its ultimate cause.
Hello, my name is Jennifer Teuchert Walsh, and today I will be discussing who was responsible for the Slater & Gordon corporate failure, along with what we believe ultimately caused the unwinding of a previously well-respected and well-performing law firm. Firstly, I will start with discussing who we believe is responsible for the corporate failure. Andrew Gretsch is the Group Managing Director and has held the role since the year 2000. Gretsch is described as being overly ambitious and the lead architect of Slater & Gordon's modern existence. Under Gretsch's management, they became the world's biggest law firm, and the shareholders and staff perhaps overtrusted him before it all went wrong. Gretsch wanted to buy British insurance company Quindell for $1.3 billion, and on announcement to the market, shares peaked, indicating the market was in favour of the purchase. Gretsch's involvement, along with 4 key executives, will be discussed along with the major causes for failure. Some responsibility with regard to accounting practices and poor due diligence must also be laid on the Chief Financial Officer, Wayne Brown, who resigned from his role in October of 2015. Firstly, the major causes for failure include poor strategic decisions. There was insufficient due diligence prior to acquiring Quindell. There have been reports questioning the financial health of the company, and these were evidently not taken into consideration before the acquisition was made. It has been reported that they had inadequate knowledge of the UK market. If they were well versed, they would have known that government wanted to amend tort legislation restricting personal injury claims, which they did. When the legislation change happened, Quindell's anticipated earnings reduced immediately. Secondly, the board is not independent from their management. Publicly known as the Gang of Four, as suggested earlier, executives Kath Evans, Ken Fowley, Hayden Stevens and Gretch had significant personal financial investment in the company. Decisions and performance of the company had personal consequences for these key members. In addition, all members had spent the majority of their working life at the firm, and that they believed that they could do no wrong. They'd reinforce each other's ideas, which had historically worked well. They had an overconfidence in Gretch's ability along with their own. Another cause was their rapid over-expansion strategy with acquisitions. Slater & Gordon engaged in unsustainable, rapid acquisition blitz, where they acquired 40 firms between 2007 and 2015. Many of the acquisitions proved to be ill-judged, and Slater & Gordon were too reliant that their growth would be from these acquisitions. Lastly, inadequate treatment of the work-in-progress account and accounting. There was inadequate treatment of the work-in-progress account, which resulted in large reported profit, however poor cash flow. In essence, they were reporting a cash-negative business with a no-win, no-fee model, resulting in delayed payment or write-off if the case was lost. It is further alleged that between August 2015 and February 2016, there were over 20 statements that contained accounting errors relating to profit guidance and financial results. Thank you for listening. I'm Teuchert Walsh, and I will now hand you over to Conor Doyle.
Hi, my name is Conor Doyle, and I'll be discussing how Slater & Gordon's corporate failure is linked to the accounting disclosure and corporate governance. The breakdown of Slater & Gordon was caused by irregular accounting practices by the company themselves as well as that of Quindell, and the blind following of the CEO, Andrew Gretch, who had become known for his phenomenal results in the years before the collapse. Skeptics of Slater & Gordon had warned that the company resembled a roll-up operation, where the company had little organic profits from business activities and kept its operations going by consistently acquiring smaller companies and displaying those profits. This approach, adopted by Gretch, showed investors great returns and led to a culture of backing Gretch regardless of the decision he made. This lack of accountability led to poor corporate governance, as when it came to the Quindell deal, Gretch was able to talk the board and investors into raising the capital for the acquisition despite evidence of Quindell's shady past and an inflated purchase price. The company was also misleading its investors in relation to its accounting disclosure, particularly in the estimation of the work in progress. This is work that's yet to be completed, however the estimated return on this work is written into profits and displayed to shareholders, being combined into the final figures. Slater & Gordon has a no-win, no-fee policy, making their work-in-progress amounts much more questionable, as some of the work may bring in no revenue at all. However, these were recorded at inflated amounts. The buy-up of smaller firms compounded this issue, as Slater & Gordon were taking smaller firms' undervalued work-in-progress accounts and inflating those estimates. The failure to pass on an accurate estimate of the potential earnings showed a lack of interest by the company to provide stakeholders with accurate accounting disclosure.
Hi there, I'm David Brewer, and I'm here to examine and explain the consequences of Slater & Gordon's poor business decisions. First off, spiralling seemingly uncontrollable debt. The acquisition, as previously noted, was overvalued. Accounting records were misleading, and now all major banks have sold their shares alone for 30 to 40 cents in the dollar, resulting in major decreases in share price / firms' overall equity amount, vast writes down in assets and predicted earnings, and also there's still the high cost of the interest liability. These poor business decisions by Slater & Gordon have created the perfect storm of disaster, heading the company into one clear direction: collapse. How to predict business failure? I'm no psychic, but numbers, they don't lie. The best known model for predicting a business failure is Altman's Z-score, which uses the following equation. A result of 2.9 or higher is safe, you're all good. a result of 0.81 to 2.9, you're in the grey zone. Cause for concern. A result of below 1.81, and you seem like you're in financial distress. Using the latest publicly posted balance sheet in December 2016, Slater & Gordon's ultimate Z-score was negative 1.69. The last 3 annual balance sheets all show distress zone figures. Uberman's research for predicting corporate value noted companies with 3 periods of consecutive distress zone performances were likely to end up in corporate value. Furthermore, the firm's auditors Ernst & Young also showed cause for concern about the company's ability to continue to operate. An ethical dilemma has arisen during this whole disaster unfolding. Dividend payments to shareholders have been cut, yet the board of directors still saw fit to award themselves performance bonuses, which saw massive backlash in shareholder satisfaction. There are 2 lessons we learned from this case, both of which are reinforced by Midway's research into causes for corporate value. Number 1, poor strategic decisions. Slater & Gordon sought to expand where new laws were being introduced that would limit their operating capability. Number 2, overexpansion and ill-judged acquisition. Slater & Gordon bit off more than they chewed. They expanded too quickly and paid way too much, and now they're paying a heavy price for it. Their firm probably won't survive this. I'm Brewer, and thank you for listening to our group's report into Slater & Gordon's unwinding corporate value.